I think we should be live. There we go. What's up, everyone? As always, we have no shortage of technical issues when you're really not meant to be doing this stuff and kind of figuring out how to do it anyways. Hope everybody's having an awesome weekend. It's been pretty warm here, but we are still getting it done. I think tomorrow we might go take a day up to the mountains, check that out, see what's going on. So we are kind of still just enjoying the weather and getting out, getting about. So today's stream, I want to walk through, really, I don't want to call it a resurgence, but it is kind of a resurgence of the whole meme stock craze. Things have been going pretty wild with names like Open has been all over the place. So I want to take a little time to poke through those. I do want to talk about the GameStop coverage triangle that is still on, still chugging along. And then if we have time, maybe talk a little bit about one or two other names that are on my radar. But the thing that I want to start with is at a macro level, meme stocks, they still fall in line with the broader market, right? They'll buck the trend a little bit, but they don't behave like standard market leaders in that if the broad market is down, market leaders sometimes can be unchanged or even slightly up. That's not so much the case with meme stocks. More often than not, they really do require, other than the periods where we might be going through some sort of squeeze. But beyond that, they tend to follow more in line with what the broad market is doing, which is a really important function to be aware of if you trade them, because small caps have actually been hotter than large caps over the last week. So that also sends a lot of meme stocks into just a general tizzy. There's a lot of people speculating in there, trying to drive price behavior, as again, we would expect from there. So what I want to do is, as usual, I want to start with just taking a look at some of the larger meme stocks, but I want to start with some basic research on mentions. And this is one of the I don't want to say better ways, but it's definitely one of the more efficacious ways to track what's gaining the most traction based on mentions. So there's a couple different websites that do this. As you all know, we've looked at a bunch of them together. So what I'm doing is grabbing a few of them that we've used previously, and we'll just see what they're identifying here. So pretty much all same names on this list. Maybe NAV and ESTC could be interesting to look at, but MSTR standard, NVIDIA standard, Snow standard, like Tesla standard. Most of these are just super, super highly mentioned. Let's take a look here. Fly, that's kind of a new one. So that previous rank there used to be 70. Let's take a look at that one. That one's kind of curious. UTMA, Archer, that one's an interesting one in general. Open, as we know, has been pretty busy. They fell down from 4. IREN, we've seen that before. KYTX, relatively new. And let's take a look over the last 14 days. Where does it update these? There it goes. All right. Intel's on there slightly, which is interesting. United Health fell off. Okay. So first, let's start with Open. And it's just because Open has been all over my feeds, and I actually haven't followed Open, the stock, like super close, but I know that it's developed a pretty significant cult following. So I'm grabbing our typical tool for this, which is X. And let's see what we can find related to Open. So this dude, Eric Jackson, has definitely become one of the central pieces I've seen around Open. I don't know this dude from a hole in the wall. Can't say anything about him. I literally don't know him at all. I don't know anything about his background. It's not even like a personal know him. It's just I haven't seen any of his work, so I don't really know what he's about. But I have seen him popping up in stuff like this, which is definitely closer to the center of the whole Open thing. So what? This is fucking stupid. Why the fuck is this dude standing outside of Drake's? Yeah, why are they here? Hold on, I gotta listen to this. That's fucking clout chasing, dude. Like in the absolute, like in the, again, I don't know the dude, so I don't want to fucking say anything crazy, but he didn't say anything here that would logically connect fucking Drake to Open, other than the fact that it looks like he's just looking for clout. I haven't seen, like, there definitely have been some celebrities that have at least some interest in the stocks and stock market. Like, I've seen that. So that all makes sense. But yeah, this is kind of lame. And this to me just looks like straight clout chasing. But let's see. All right, so standard meme stock stuff, the whole I won't say anything, but there will be signs. Get that. Okay, so everybody's really trying to pump Open. Like, that's what this is. They're just trying to get more and more awareness on it. So let's get the narrative behind Open. Let's go to our friend Gemini. Explain the narrative behind Open stock. Wait a minute, Lauren. You're saying he craps on meme stocks and Roaring Kitty, but wants... Wait, has he actually talked shit about either meme stocks or the cat? I don't see how that could be fucking logical at all. That's wild. If that's true, like if either of those happened or both, that's fucking crazy. All right, so let's see what Gemini says the story is that we're dealing with right now with respect to Open. Maybe Grok would be the better tool for this, eh? Because Grok will be able to comb all of X as well. So let me just grab this. I'm going to throw it into Grok as well. All right. Pioneer the iBuying model, captivated confounded investors, oscillated widely between revolutionary disruption of the real estate industry. Okay. But why is it becoming a meme stock? I understand that the technology, like stuff like this, more often than not, there's some sort of underlying driver of value. So this seems like it's legitimately based on something, which is cool. So let's see this. Stock has caught the attention, retail, potential meme stock, new layer of volatility. Yeah, but why? Okay, there we go. So short squeeze potential. Okay, so that starts to make sense. Some level of like that I get. So let's see what Grok says, because I think Grok will actually get us a slightly better answer here. Yep, so this is what it is. Tech innovation, economic challenges. Yeah. Scalable growth, okay. Meme stock territory. So this is almost like verbatim what Gemini put out. Okay, so it had decent short interest. Over 20% is actually not that crazy, though. That's high. That's definitely, if you guys have seen the video that I put out on short squeezes, which is a part of my book, I have specific scans designed to find things that are likely candidates for short squeezes. It is a thing, but 20% is definitely high enough that it starts to get interesting. But the other thing that really is super important is not only the short interest ratio, but the days to cover. You need some sort of latency. So let's see what open short interest is. And typically we have to use a couple sources for this. This one is NASDAQ. A lot of times I'll use like Fintel or FinViz. This is FinViz. And then let's see if Fintel has. No, this is, I don't want Riot, dog. I want open. I'm getting put through a CAPTCHA real quick. All right, let's see. Open. Oh, bitch. There we go. Okay. So now we have a few to look at. Let's see what this is. Yeah, see, like this doesn't mean anything then. When you see short interest flow above 20%, that's interesting. But the problem is this, the short interest ratio in DTC is so low that it's very easy for any of the shorts essentially to close their position within a day. So the problem with this is it really limits the potential for a short squeeze when the people that might be short have quick, easy, cheap access to a methodology to cover. That's what made GameStop, especially I don't want to call it pre-dilution, but pre-offering. That's what made GameStop such a fascinating stock for a while, because so much of the float had been locked up that days to cover blew out on that. And it actually, like, it literally became a process where the shorts had pretty significant risk that, again, we can get more into detail because I think a lot of people overestimate the risk to shorts. What I mean by that is if you're short stock, you can always hedge with options. And that's what a lot of them will do, especially during really crazy parabolic moves. So that's a whole other bag though. So anyways, with short interest ratio this light, this doesn't, I wouldn't consider this a short squeeze candidate current state. This says 0.78, 24% of float. 24% of float is heavy, to be clear, but take a look at this. One of the things that's also very interesting to see is that the short interest overall is actually expanding, right? That's interesting because that's essentially the shorts saying, I think this is too high and I'm not fucking scared. Like, that's what this means. So now the question is, why? Why open versus anything else? I'm just trying to understand, like, what the... Dude, that's... What the fuck is this dude talking about Drake for, dude? Get off Drake's dick. 140K insider buys. So they're trying to pressure insiders to buy shares. That's good. I don't know why that is such a big thing here, but I think that's good. I always think it's really important actually to see insider sponsorship. That I think is completely fine. It's always very suspect to me when the people who work for the company don't want to hold the stock with their own money. So completely agree with that. So who's this? I don't understand the narrative between Eric joining the board. What's the why? Let's see.
For a very long time. What do you think about her stepping down, and who do you think should be the next CEO?
I think it's the right thing to do. I don't think she.
So they're just talking about the CEO stepping down and that's a good thing. Okay. This is fucking mind-boggling. I don't fucking get it. The thing I don't fucking get here is the technology itself. Cool, right? Like if you fundamentally believe in the company and you think that it's a good fundamental company, great. That's completely fine. I don't even know what Open does. That's what I'll do next, is to get a better sense. Obviously, I know it's in the real estate and the technology side of facilitating transactions, but I want to get a little further into the weeds. But I just don't understand why the intense followship of it. We're asking him to buy a share of Open. Jesus Christ. That's so fucking lame, dude. All right, so, oh, this is actually great. This is perfect. This is what we need. So 50-1 reverse split. Okay, so they're talking about taking out the shorts. Okay. These, man, these are so interesting. This is the kind of shit that just absolutely draws my full attention, because there's so many things going on under the hood here. We'll take a look at the options. I've been trading the options in Open because it's just vol, right? From an actual trader's perspective, I am looking to monetize that vol. But there's like a cultural component to this, because the people that are calling for a squeeze, which is fascinating, aren't like, this isn't a stock that's a great candidate for a short or gamma squeeze. Then you layer on the fact that a lot of the stuff that I see being talked about here is a fundamental component. That's a much longer road. which is interesting because most of the time where I see really, really strong retail support, it's on things that they're expecting really near-term payoffs. So the fact that this isn't that is quite interesting to me. Okay. Got it. Okay. I understand it better now. Funny enough, out of everything that I've looked at so far, this is the most fucking interesting thing that I've seen. And this is, thank you for, we'll hit him up. This was helpful. Thanks. That was good. Okay. So obviously then there's a really strong expectation of upside appreciation, and you can see that essentially rallying off the stock moving from 50 cents. So this definitely had an element of a squeeze for sure. Like, this looks squeezy to me. Now, I don't know exactly what happened leading into this in the timeline of stuff. I honestly don't care that much. But like, this is pretty clearly positioning, right? This is when people get caught off sides. They were obviously able to rebalance. Let's take a look at what the short interest was on the 21st and the 18th. This was July. Yeah, so back in June, it was pretty high. It ramped up big from April. So April into May, short interest grew pretty significantly. Then June 13th kind of peaked out. June 30th came down slightly, came down again July 15th, and then back higher on the 31st of July. Again, these are 2-week reporting windows. And then August 15th, it's back up almost to all-time highs. So this definitely is being scaled into from the short side. Now, the trick here is, I think, unfortunately, a lot of retail is likely to be the exit liquidity. That's my underlying suspicion. So the next thing I'm curious about is, what is institutional ownership of Open? Yeah. So the institutions are really getting behind it in Q2 of this year after finishing an unwind. Yeah, that's exactly what I would expect to see. So these are, we need to see this or this. That's a big position. That's a really big position. BlackRock scaled down pretty big. I mean, they got in at a decent overall average price though. And then Vanguard just got their face ripped off with an average of 14. Because it's super clear, if you take a look at the longer term history, there's a lot of people that are fucking deep underwater on this thing. I guess you got to go back even further. Yeah, because this thing was all the way up in the 30s. When did this thing come around? What is this? July of 20? So July of 20 came out. And then the last question I have is, what is the intrinsic value of the stock? I'm actually very, very curious between that and the PE ratio. What is the intrinsic value of Open, as well as the trailing 12-month PE and forward 12-month PE ratios. Because I imagine right now it's probably pretty excessive, I should just say. Open earnings release. I want to see their latest earnings report. Yeah, that's bad. That's so bad. That's fucking trash. That's absolute trash. Look at that. Let's take a look over the last year. Look at that. Look at that. Oh, man. That is hot garbage. The fact that insiders have been unwinding that heavy. So what? Over the last year, there's a single buy transaction for $128,000 against 4.7 million. Oh, that's comical. That's so funny. Nothing says I like my company like this. Whoa. That's crazy. If the intrinsic value is actually 858, that's kind of nuts. 726? See, like this, how is there such a difference between these? Oh, okay. So this is saying a 3-month time horizon. And then forward PE looks a little bit better, but it's interesting that it's that different between these. Let's see. Okay, I don't know what the fuck this shit is. $858. If that's actually the DCF model, if that's actually a DCF model valuation, that's super, super interesting. And this is awful. Where's the fucking... They didn't even make a deck? That's crazy. That's so fucking lazy. Let's see. One of the things that's helpful when they put this stuff in decks is they just make a bunch of visuals for you. It makes it way easier to, like, just to get a better sense of. All right, so revenue is up year over year, up pretty big. Quarter over quarter, actually, bigger than I would have expected. profit. I'm actually really surprised that this thing is so suppressed. Oh, here we go. Wait. This is actually kind of interesting. This doesn't look that bad to me. Huge call premiums. Mostly coming in above the offer. The thing that I'm struggling to grasp right now is, why was this a penny stock right before this? That just doesn't make sense. This doesn't seem like it would be a penny stock. Why did it get so beat down? Because the short interest wasn't that crazy to suppress price. It was in the teens. Why was it so cheap? Don't understand. Because it absolutely was growing slightly. Let's take a look at the financials. Okay, so it got smashed in 22. What happened there? Net income came in negative 928. Did they just build a ton of inventory? My guess is they did something there with their inventory. Those sales was, while sales was slow massively, it's still, oh, that's so interesting. 21, they got murdered too. What happened? Let's see. 20, 21. So debt skyrocketed. Sales went up crazy too, though. So did gross profit. This doesn't actually look that bad, man. Why was this thing a penny stock? So interest rates naturally would hurt. That makes sense. But a penny stock, that just seems excessive. I gotta be honest with you. I think fundamentally, I don't see why it would be so cheap. Like here, I can understand a little bit better, like being the $1-2 range and whatnot. But being sub dollar, that just seems real extreme to me. How did it do on its earnings there? What was the date on this? May? How did it do in May? So not bad. Yeah, this didn't look bad in May. Curious. So the options here are absolutely wild, though. Again, as per usual, I think that's really where the opportunity is. So if we take a look at percentile, the front is getting sold off big, but the tail end is still really high. So the 30 and 60-day vol is still in the mid 80s. And funny enough, it's still mostly on the put side with really, really big put skew. That's kind of interesting because a lot of times when you see stuff skewed that much in terms of OI to the upside, you tend to see a bit more skew in the vol. Yeah, Ivy cratered after this. That would have been a really nice trade anywhere in there over those few days. Totally missed it. But that's for those that are a little deeper into the options world. These kinds of moves here are absolute gifts for trading vol. There's so much you can do here because your overall risk comes down actually quite a lot when you're trying to trade vol around this sort of movement. Because one of the benefits is, you know, that the vol there just gets absolutely jacked and it's absolutely temporary. That vol is not persistent. So that's always an easy fade in vol. This is a little bit different, and it's because it's basing up here. Whereas here you could tell made an extreme, got shoved all the way back down, had a gap, and then got shoved all the way back down again. That's a lot of downward pressure over these 2 days. That's very different than what you see here, where big rally kind of opened up within here, definitely a big rally up, got shoved all the way back down, but has now been kind of range bound from that time frame. And then the fact that it closed this high on this candle was also a little less than expected, at least from my lens. So if there's put skew, let's see, 172 for a 32 delta. No, okay, it doesn't. This is, I don't know what this is using for the vols. It's just got to be using like the at the monies or something. $182. Let's do October. I guess it's limited on the strikes anyways. Huh. I don't know what this is using, but this is using a weird, this is using some sort of weird calculation. I guess it's not, because this is saying that the fives are 170. Yeah, okay, so this is still showing skew. It's just way more pronounced at the tails. So then this is an instance where the tail looks real curious. The 1.5s. Yeah. See, look how rich that is. 194% vol at the 1.5s. Now, again, this is really cheap stock, so it's hard to visualize. But I'll give you a comparison so that you can kind of get a sense of what I see and why I think that it's interesting. So if we look at expiry, and then we look at 2 different expiries. And then I also want to look at a couple different deltas. We'll do 1 expiry just to make it easier. I'm going to move this off to the side for now so that we can get through this a little quicker. What I want to do is give you a couple different things to look at. So this is all for 17 oct. And we're going to look at the 30.32 put. We're going to look at the 0.11 put. And then we'll look at the 0.01, 02 put. And then I want to do the same on the calls. So this will be call IV. This will be put IV. Okay. So here we have 172.8%. At the 11, it's 169 giggity, 0.3%. And then the 2, I guess it's a 3, I should say. 3. That is 193.5. Okay. And now let's take a look at the call IV real fast. 32 is 197.8%. The 11, it literally doesn't even have. Yeah. So the furthest out of the money that this goes is a 24 delta, which is actually kind of nuts. Which is another big reason why the skew is so weird on the put side. So the 24 delta is 208.1. I'll do 24 delta on both of these so that we can at least compare those. That's at 170. And then there is no super far out of the money. Okay. So if we look at these really quick, and we look at the comparisons between these. Yeah, that's better. So then 267 should be labels. There we go. So at the 32 delta, I mean, the put IV is lagging pretty significantly to the call IV. The surface in here is very skewed. Yeah, the surface in here is super, super skewed. The $2 put is 175. The $5 call is 179. And that's a 6 delta against a 56 delta. So there's a bunch of different ways to play this, because there is put skew, but it's out at the tails. So the way to get at that put skew out at the tails is you could do it a bunch of different ways, but to give you a little bit of context here, those are the 1.5 strike is giving you can't trade in thousandth pennies, unfortunately, as a retail trader. So you're going to essentially be at the bid or the offer. So in this case, let's say that you get out at the bid. So you're going to get 4 cents, but that doesn't seem like a lot. Well, because it isn't. But if you look at that as an overall percentage, if you were to cash secure that position, it's literally 2.7% return for 48 days. And again, for most people that are used to hearing of kind of ridiculous returns, if I look over 48 days and we're at, what did I say, 2.7%? That's a 22.5% annualized return. That's selling literally a 3 delta put. A 3 delta. So to give you context, just for a comparison point, we'll look at SPY and Tesla for 2 comparative names so that you can hopefully understand the context of what I'm saying. So this is strike, this is premium, this is percent ROIC, and then this is delta. Because what you're going to find is that this is actually a pretty ridiculous return, actually. No, don't do that. Okay. So I'm going to go into the same expiration first for SPY. We're going to have to add way more strikes to get to those tails, but they're there. So we want to be at the 3 delta, which is here. It's the 530s. And the premium for the 530s is 0.84. And that's a 3 delta. And then we'll do one more that's a little more volatile than SPY. SPY is just kind of like the benchmark comparison. To give you, again, just general context, let's go to that 3 delta right here, which is the 215s. The 215s is going to give us $1.05. And the delta there is a 0.03. So let me show you what this means. If we look at the return on invested capital here, comparing these, take a look at what you see. It is an absolute blowout in favor of Open in terms of how much you're getting for those tails. It's an incredible amount. So the other cool thing is, with this thing being such a cheap stock, even small accounts, they can be naked here, right? Because in order to cash secure a put, you're putting up $150. So it's relatively cheap. And you can also do a spread here. I wouldn't want to, because the commissions are already going to be pretty unfavorable. Open, unfortunately, being such a cheap name, the commissions will eat into a decent amount of your P&L here as a percentage of the premium you collect. So in order to put stuff like this on, you have to do it at scale. But the other thing to keep in mind is that even if the stock goes down, that will overwhelmingly likely be accompanied with a contraction in vol versus some sort of expansion in vol. And that's just because vol is already so high and it's really, really juiced up in the tails. Look at these. 242% vol. at 1 delta. At the 2 strike, you're in at 3 pennies and you get 215% vol. So really, really interesting from an actual trader's lens, what we see in open. From the stock itself, it's really interesting, and it's very, very clear that the stock itself is definitely struggling, and the intrinsic value being as low as it, well, as high as it is, and the stock price as low as it is, there is a dislocation there that does lead to a pretty interesting disparity in value. Yeah. President had a 30,000 share buy. Incredible work from the president. The president of Open is really, they're really doing it. There they are. There they are right there. Look at that transaction. A nice 30,000 shares, putting up a mind-numbing $128,000. I mean, what a PR play, right? Just tremendous. Fucking ridiculous. I wonder what the salary is for the Open CEO, if that's out there. What is the salary for the president of Open Stock? I don't know the answer to this, but I'm curious. And then anything else you guys want to take a look at? We kind of did a little bit of a deep dive on Open, which I'm actually really glad because it showed me a couple interesting opportunities in here. Brock is thinking real hard. $700,000. Cash bonus 50%. Guaranteed minimum $500K. Plus a retention bonus of $250K. Like, this is crazy. So they literally, the CEO with their $128,000 purchase has put well less than 10% of what they're going to make in 2025. That's not like 10% of their fucking money. That's 10% of what they're going to make in 2025 into the stock. It's just it's an absolute joke. What's the total position that they have? That's it. That's trash. It would have been cool to actually see like a pretty meaningful transaction go on there. Lauren says excited what GME has been beta testing. Yeah, let's take a look at GME. It's been a minute. Kill. So, oh yeah, and I did tell you guys that I would talk to you guys about the GameStop covered strangle really fast. That's been performing absolutely beautifully. So the covered strangle right now in GameStop, the total return on invested capital is 19% or so. So the covered strangle for the comparative time frame that I started trading this, when I first started trading the covered strangle in GameStop, it was at $24.31. So the stock is now down to 22. So the stock is down about 7.8%. So the premium over the buy and hold equivalent is massive. It's outperforming by 26.8%, the covered strangle itself. So the covered strangle is crushing it. It's still getting really strong return on invested capital as far as the total premiums that are being traded. So in this case, to show you what that looks like on a comparative scale, I think I'm in 19 SEP. I'm in here. And I had the 21s and I had those for $1.20. So to complete this same thing, well, let me do a straight comparison at least for a 3 delta, which is these. So that you get like 5 cents at the 15. So you can see GameStop for the tails is kind of like a middle of the road here. It's definitely nowhere near open. Open right now is quite literally parabolic. But if we take a look at the closer deltas, so we'll do another one of these. And in this case, I'm looking at the 21s. Those were $1.20. The delta was a 0.3. So if you take a look at the return on invested capital for the higher delta options here, absolutely smash, right? 5.7% return on invested capital. And again, this is for, at this point, it's a 20-day trade. So we can update that. I think it was like 65 cents. So 3% for 20 days. Absolutely incredible returns there. So the main thing that I want to highlight though in GameStop comparatively is that GameStop goes back and forth in terms of where you get the skew. So if we take a look at this 30 delta strike here, the implied vol is 66.6%. We take a look at a 30 delta strike here, the vol is 76%. So the skew is still to the call side, but that ratio has contracted a lot. It used to be that the calls could almost be 2.5 times what you see in terms of vol on the put side. So this is actually why this is such a fantastic candidate for the covered strangle, even for smaller portfolios, because the stock is super cheap. It's 22 bucks. We can see that it's absolutely trading near at least a perceived intrinsic value. It's effectively been sideways from 12 June on. So it's been super, super steady, which leads to decent accumulation zones. Because I think my overall P&L here is on the stock, I'm down some money. In the sample portfolio, I have 350 shares at 23.61. So even with that $4.20 or $420 loss in terms of the stock itself, on the call side of the equation, that's up 940 bucks. So the short call side of that, and that's been at a pretty light ratio, I should add. This is also showing me I kind of want to add a little bit more shares here as I'm looking at this, because it's about time. So the covered triangle in GameStop is doing really, really well. And let's take a quick look at the beta testing, because I don't know what the latest news on GameStop is. And you said some sort of beta testing. Let's see. And then I just want to take a look at the options chain in there in the vol. Let's do the last year. Pretty quiet in here too. At least this is like 2-to-1. That's good. Let's take a look at the vol. Super cheap. This is a great example. This is literally such a great example for the post that I just made on Reddit. And I just talked about this. And we talked about this on Friday in the buying versus selling premium conversation, because it's really, really common for people to say, again, you buy premium when it's low, sell it when it's high. But if we take a look at what premium has been here in GameStop, it's been low. And what do we notice? It's been low for some time. But if I take a look at the risk premiums, take a look at the risk premiums. This is actually one of the best possible examples that I can draw. I'm going to grab some screenshots of this and then build a view for you guys. Because this is the exact thing that can be really, really hard to understand. So this is using 30-day vols. So I'm going to get rid of the rest of the vols here so that it's simpler. So if we line these up, right, if we go back to like June, July, what do you notice? June, July, there's the fattest risk premiums. Yet between June and July, here, IV percentile is literally at the absolute floor. This is the perfect visual of that exact effect that I've talked about a lot, and something the more nuanced option trader is aware of. The standard simpler options trader doesn't know this because they're following overly simplified concepts that, again, cost them money in the long term. Because we can also find, let's take a look here, May 23rd. If I look at May, this is where vol is super high, is it not? But then if I take a look at May here, what do I notice? Realized vol was greater than implied vol. Lost money. Implied volatility percentile, vol's super high, but I lost if I sold. So this is why those monikers, those really, really basic things often lead people astray, because they don't understand this kind of nuance. This is such a great visual. I need to make sure I save this for you guys. It's absolutely, I'll add this to my big, ugly deck of examples and shit, because this one's really good. All right, guys, that's me out of here. Be an outlier. See you guys later.